I must first confess. So this particular video idea has drawn a great deal of inspiration from this recent video that is popping off on YouTube from this channel called Contra Turtle. And in the spirit of this Spanish painter called Pablo Picasso, good artists copy, great artists steal. And I'll leave it up to you to decide on whether I'm good or great. But I think in all seriousness, especially a call out to my fellow investors that are in the weeds of managing a portfolio, looking at companies, doing your research, assessing your allocation. Sometimes we are deep in the woods and we forget about the how and the why. Also add more color into the discussion around the topic of money, what our objectives are, and we can seek to agree to disagree or to give you a different perspective into looking at this whole investing game itself. I'm not too sure how I'm going to title this video, but probably something along these lines. But I'm not going to contextualize it to the Singaporean psyche. Even though I am going to share my own personal journey, and because I am based in Singapore, I will have to give you that broader context, especially for my foreign viewers. But don't worry, I think a lot of all these calculations and philosophy is quite universal, so you can apply it across the globe, regardless of where you're from. And with that in mind, let's get started. And don't forget, as I've subscribed to Contra Turtle, I do hope that you take a look at his video after mine, and you also don't forget to subscribe to this channel on your way out. Just to give you a bit of a perspective as to where I'm currently at, I'm 26, turning 27 this year in 2025, and I currently run a portfolio of roughly 200,000 US dollars in terms of current valuation. And if I had to convert it to my local currency, that's roughly a little bit over $250,000 in Singapore dollars denominated terms. So before we dive deeper into it, I think it's important for you to understand and appreciate my personal philosophy on the topic of money before we talk about retirement, building a portfolio, and so on and so forth. So personally, I see money not as something to worship, but as a means to create space. Space to think clearly, to act honestly, and to live intentionally. So it's about buying freedom, the freedom from noise, pressure, and the need to please. And please don't ask me where I've gotten this enlightenment from. I'm not too sure whether it's a combination of upbringing, childhood trauma, or a combination of both. But more importantly, I fundamentally do believe that if you're constantly experiencing some sort of a financial insecurity, and if you're in that mind space, you'll never be able to do things true to yourself. So that's always the first part that I wish to square away, and it has been one of my highest priority, at least when I step into adulting, which also explains a slew of my other actions that I'll talk about later on. Now, the second underlying philosophy of money is that optionality in and of itself is the ultimate goal. So it's not about early retirement, but about having choices. More so, the choice to walk away from bullshit. So it's a powerful enabler of agency and alignment. And on the third point, where I personally feel that the comparison game is a trap. Early on, I think especially for those of you that have went through a pretty homogeneous kind of education system, it's easy to measure success in numbers, whether is it in terms of exam, grades, marks, salaries, titles, square footages. But I think with time, even at my current age, I find them all a distraction. So I like to engage in ideas, thoughts, and most importantly, personal conviction. So with that in mind, the natural question would then be, how would you know how much do you need to personally retire? So one of the very simple benchmark is to of course look at averages. And they give you some sort of a reference range in terms of your ideal lifestyle and how much is required to lead that particular lifestyle. At the simplest of the simplest lifestyle, you are probably looking at roughly 2.7 Singapore dollars per month. And on the higher end, you are looking at $6,000. So yes, that's a good reference point, 2.7 to 6,000. But where do we personally fit into this? And of course, these are just benchmark guidance. How do you know what is your own personal number? And I think a bigger issue when you always look at this kind of reports is that you're always probably in one of two camps. The first camp is, oh, that's great, I'm probably on track. On track by how much? I don't know. But just looking at this number, I can roughly estimate what my retirement be. Or on the other hand, you might be someone on the other end of the spectrum thinking that, oh, retirement is too far a topic, this is too much money, I'll think about it when I grow older. So that's why I think in the spirit of this video, hopefully I'll be able to provide you with some sort of a framework into understanding how much is needed, and so that you can get a little bit more clarity while I share my own personal planning in this case. So I do think that it's also important to visualize and to tailor a lifestyle that you personally want. Don't care about what other people are doing, what the median US citizen or Canadian or Australian or Singaporean, don't care about what they're doing. So you should not approach it with a cookie cutter guideline. So personally, I think I lead a pretty minimal lifestyle. But I really don't need much to be happy. In fact, a lot of the things that I enjoy doing are probably free of charge. But more importantly, something that I wish to introduce here is the concept of a money DAO. And it focuses on your ability to prioritize what's important in your life. So for example, if you think that clothing's how you dress, how you look in front of people is your highest priority, and you are willing to spend $500, $1,000 a month on clothes, then so be it. I think if it makes you happy, it's perfectly fine. However, that said, life is full of trade-offs. So if you're allocating a disproportionate amount of your income or your savings into something like clothing, then you probably have to cut back on things like your food, your transport, your outings, your traveling, etc., etc. So it's really just a reorganization into understanding the different priorities of your life. And in things that you think are important, you dial up the money down. You're willing to spend money. You're willing to invest. On things that does not derive as much utility, you can then turn down the money down and to focus on saving from those parts of the equation. And just understand that there is no one-size-fits-all solution or answer. You just have to make peace with that. So just to give you a bit of flavor in terms of my own personal expenditure, I've dug out what I've spent in 2024, and you can see that largely speaking, my core expenditure column, which is what I spend on a month-to-month basis, actually revolves around a pretty tight range between $500 to $700. Based on my conversations with quite a lot of people around me, I'm probably on the lower side. And a very large part is because even until today, after working for quite some time and hustling and whatnot, I still try to live as much as possible like a student, back then when I was still a broke university kid. But just to also put out the disclaimer that this expenditure table does not include my parents' allowance and also does not include my own personal insurance premium. But just to plan around my core expenditure on a monthly basis, I do think that I spend roughly $1,000 to $1,200 per month. And if you don't have the habit of tracking your expenses, you probably don't have to track down to the T. But I think it's still good enough for you to know where money is generally flowing at so that you can engage in this exercise alongside with me. So then, if we were to reverse engineer the process into understanding how much you need to retire, you have to first understand how much do you work towards, or what is your ideal retirement income. So I'm personally working towards a $3,000 per month kind of income range. And I'm careful or wary in terms of floating this idea of passive income, because I don't think that there is anything truly passive in this world. There is still a great deal amount of work, and I don't want to come across thinking that it's easy to get passive income or to build this sort of income stream. But let's just say, why am I working at $3,000 per month? Because if I were to look at how I'm currently spending, of course, if I'm able to lifestyle inflate, who doesn't want to? But I think on a bare minimum, if I'm able to eke out a $3,000 per month, which translates to roughly $36,000 a year, I'm able to give myself quite a bit of buffer because I have not buffered in parents' allowance and insurance premiums. And also, my ideal so-called retirement lifestyle would include me traveling maybe 1 or 2 more trips in addition to what I've done in 2024. So I'm personally quite happy with whatever that's going on right now, but optimally, I want to travel maybe once per quarter, and there should be enough buffer with $3,000 per month. And specifically, I don't have any obligations at all for now. So there's no kids, no car, no mortgage. And I'll talk more about that later on. And some of you might be throwing your arms in the air saying that, oh, you have got such a good life. You have no obligations. Of course, you can plan out a lot of all these lifestyle preferences. So yes, of course, I don't want to deny that fact that I'm in a pretty privileged situation, but the mortgage is going to come sooner or later because I have to move out. The car and the kid really depends on the couple preference. So with this $3,000 benchmark in terms of income, I now would use the 4% rule that is in the personal finance space in terms of how to aggregate and to calculate how much you need for retirement. So very simply put, you need $1,000 per month in income, you need a $300,000 portfolio. You times that by 3, you need a $900,000 portfolio value. But let's also not forget about the silent killer called brother inflation. So we'll talk more about that later on. But for those of you who are more interested into this idea and concept of the 4% rule, so long story short, I think the study of the 4% rule is a well-documented one. It's not necessarily a 100% foolproof way in terms of saying that if you have a $900,000 pot, you can draw out $3,000 per month perpetually. In fact, I think a lot of them have run many simulations, and specifically for this case, they have ran the simulations all the way from 1871 until modern day context of 2023. In this 100 over years of different simulations, there were 4 years in total that actually didn't stood the test of time of drawing down this portfolio on a 4% withdrawal rate. And there are a few key risks that includes the sequence of return, inflation, etc., etc. But I think to dumb down this conversation, let's just use this 4% rule as our benchmark. For those of you who are a little bit more pessimistic or skeptical, you can use a 3.5% or 3% and whatnot. And I'll talk more about my own personal situation a little bit later on, about how I intend to combat this potential issue of drawing down the entire portfolio before I actually pass on. And the median amount that you will be left after this 30-year time period is close to $2 million, even though you started with only $1 million. So I hope that this can kind of alleviate some of your concerns and why this 4% rule is such a powerful one. So like I alluded previously, if we actually use a 3% inflation rate and working with an ideal retirement age of, let's say, 40 years old, we have to multiply this $3,000 per month by 3% at a time horizon of 13 years. We are looking at closer to $4,400 monthly income needed. And using that same 4% rule, we are looking at closer to $1.3 million. And this has to be invested in capital, and I don't include the home equity portion, because I don't see it as an asset unless you actually downsize or right size to extract the capital, or on the flip side, you have some sort of a rental income. If not, I don't see home as part of this investable asset. And I also don't include your 401k or your retirement equivalent, depending on where you are based in. Because I do see those asset classes as more of a buffer rather than something that you look towards as a primary driver of enabling your retirement lifestyle. Now we have our numbers. I have to get to 1.3 million by 40 years old. I have a starting amount of $260,000. I have a duration of 13 years. And the most important question that is missing in this equation is how much can I reasonably invest per month? And this is actually the most critical question for most of your own retirement lifestyle planning. I am actually working towards trying to at least save $4,000 per month, which brings up the annual contribution to roughly $48,000 a year. So that means that in order for me to reach my target sum of 1.3 million in 13 years, I actually need an annual CAGR, compounded annual growth rate, of roughly 4.6%. But of course, there is a few big caveats here to exercise this range of assumptions. So firstly, of course, I have to continue to work at my job and my side hustle, and I have to constantly innovate to perform and to value add to organizations and the people that actually watch me. So that's the first very big assumption. I have to constantly earn that, or derive that level of income to continuously contribute to the portfolio. Secondly, at least for myself, I have no car, no luxury brands, no big property, or I'm going into very big leverage in terms of credit card debts and stuff like that. And thirdly, I have not cleared many of my big ticket items yet. You can think about things like weddings, my dowry, renovations, etc., etc. So that will probably have a hit to my cash flow in time to come. I'm looking at the next 5 years or so, but I think it's really a negotiation that you have to navigate in terms of your own life, key important milestones. So I'll leave it as that. Specifically, you also cannot be a wage or a debt slave. Affording a comfortable house is important, but not so much about trying to overstretch your finances and to going into bigger and bigger properties and to carry on bigger and bigger debts. And I know that some of you look at properties as some sort of an investment vehicle. So I think all things considered, we have to go back to the balanced view of understanding what you are risking or what is the trade-off here. On the last topic of kids, parents' retirements, and medical expenses to come, I think it will remain a mystery for now. There is not a very strong indication of where this will fall, and this really depends on fate. So there is a very important element of luck in here that a lot of people tend to not discuss. But if we were to imbue in a lot of all this scenario planning, I think you will feel very paralyzed and you wouldn't be able to come up with something relevant for you to work towards. So I think all these being set aside, at least this is a good framework for us to focus on. I have 260 today. I'm working towards 1.3 million. I have 13 years. This is the amount I need to contribute every year, and this is the annual returns that I have to strive for. So simple as that, and I'll keep it as clean as possible. And of course, a small part of me being able to generate income is through some of these affiliate links and deals. And I just wanted to say that, especially for those of you based in Singapore, interested to enjoy lifetime commission-free trading for both Hong Kong and US stocks, actually Longbridge is a great partner in trying to penetrate into the Singapore market, and they are MAS licensed. So in fact, they actually recently upsized their new user promotion. For those of you who have not created an account yet, you can use my affiliate link down below. But specific to the new user promotion, all you have to do now is to create a new account with them. Just log in to your SingPass, and you can enjoy an $18 affiliate exclusive cash coupon immediately credited to your account. And if you deposit minimally 2,000 Singapore dollars, maintain it for 30 days in the account, and complete 3 buy trades, you can enjoy half an Nvidia share that is worth roughly $60 to $80. And the upsized reward is this interest boost coupon with their Cash Plus solution that gives you a 6 plus 8% per annum interest boost coupon for 90 days. And if you park your $2,000 initial deposit into this Cash Plus solution, you get roughly $70 on your $2,000 deposit in the money market funds for the next 3 months. So in total, you get roughly $148 on your $2,000 deposit. And I think it's a win-win for both the broker and also for new users. And this upsize promotion will only last until the end of April 2025. And for those of you who have not created an account yet, I think Longbridge has one of the best new user promotions out there. So please do take advantage of this link down below before they start nerfing it. So with that in mind, I think to circle back to this entire retirement planning discussion, so in the next 13 years, some of you might think that it's short or long, but personally, I have to be very consistent with my own savings plan and investing principles. And I cannot get screwed by investing. That's the most important part. I'm personally willing to adjust my lifestyle along the market movements. And to give you some sort of an example, let's say in 2023 and 2024, when the markets were booming pretty substantially, I'm willing to take more off the table. While on the flip side, let's say in 2022, when we experienced that sort of drawdowns, I'm willing to extract lesser from the portfolio itself. Or it's actually pretty risky in terms of impacting your retirement lifestyle based on market movements. So I think it really depends on how you try to engineer or structure this, because it's not necessarily a full-on equity exposure. And if I'm not wrong, the 4% rule is actually built on the simulation of a 60-40 portfolio. 60% equities, 40% fixed income. And if you're drawing down your portfolio, you probably will draw down from the fixed income portion. And there is a lot of nuance at play here, but not to get too much into the details. Just know that I'm willing to adjust my lifestyles. And I personally don't envision that my retirement lifestyle to be going to Bali and lying on the beach. In fact, I still wish to be a pretty productive member of the society. And I'll be working towards deriving some sort of an income, but maybe not so much about a full-time income with a gig and side hustle. And so on a side note, I'm also particularly passionate about this topic, about the ideas of trade-offs. And I think that this is something that not a lot of people are talking about. Take a look at it from a very mathematical lens. Everything is all about trade-offs. And sometimes when you walk into a decision, you actually don't know what you're trading off with. And this is just a fact of life where in different stages, you just toggle up and down what you're comfortable with. And I think specific in this scenario, where I'm seeing people around me, particularly Asians and more importantly Chinese, they generally love properties and they buy up as many as possible. They lever their ass up as high as possible and to get as much loan as possible, because that will amplify their returns. But I think a very big part about this is that you're always beholden by the property or rental market, your ability to maintain the mortgage payments, either through your business or your job, and there is a very high level of concentration risk. So when doing the numbers, I'm looking at the historical trends and doing out their projection, everything looks good, at least on paper. But don't forget what you're trading off. You're probably trading off your geographical freedom, because you're probably locked in this space because you own a property here, and because you have decided to dive head in and basically dial up the knob of going entirely risk on in the property market. It means that you probably cannot take risks in trying to explore entrepreneurship endeavors, quitting your job, traveling the world, etc., etc. Taking a sabbatical, for example. All these are out of the picture because you have to finance your loan. So I think all these are just discussions around the trade-offs that you have to make. And every risk areas in life have their own set of challenges. And I'm not saying that one is better than the other, but nothing is truly easy, and you just have to pick the hill that you wish to die on. Now, achieving that 4.6% CAGR is the worst case possible. Personally, for myself, I actually do have a goal of trying to at least build the portfolio to at least achieve some sort of an 8 to 12% kind of return profile. And if we punch in the same assumption at 8% CAGR, we are looking at closer to 1.8 million, and at 12% CAGR, we are looking at close to 2.6 million. And that's clearly double that of the 1.3 that we started. So then some of you might ask, oh, is this even possible? What's your track record, etc.? So for one of the larger portfolio, we are looking at roughly 12.8%, but this track record only started from the end of 2022, so it's still relatively young. But on the other account, I've extracted the past 4 years track record, and based on the platform's calculations, I only achieved a weighted return of roughly 3.5%, and that's cumulative over the 4 years. And the S&P in the same time period have achieved roughly 39%. So I've did my own math. I think not to get too much into the details, because I do use this platform as my debit card solution as well. So then the crunching of the numbers based on the baseline capital rate is a bit off. But based on my own estimation, this has probably achieved roughly a 3% CAGR over the past 4 years. So you are looking at a very wide range of between 3 to 13%. But yeah, you can see that this platform in terms of tabulation is a bit weird. I'm not too sure how they calculated negative 106% kind of return, even though this account has never went bust before. And also because for those long-time viewers, you know that I'm invested heavily in the Chinese tech space. And we have experienced that 4 years bear market, which explains this sort of very poor returns profile. But given this recent run-up, so the returns profile has almost catch up with the S&P, at least over the last few months. But like we said, I think we don't know until we reach the finishing line. But based on my own personal investment philosophy, I think I'm quite confident that I can hit at least a 3-4% CAGR. So that's that. I think the more important thing is to be disciplined, to manage the consistency into pumping that annual addition to build that portfolio up. The returns will take care of itself as long as I don't screw up too badly and to not get caught into another bear market of the lost decade of some sort. And some concluding thoughts. I think the first step is to visualize what does a day in your retirement life look like, and that should probably guide your subsequent goal setting and consistency in actions. And you must first believe that you can see yourself living that life. Then you'll be relentless at trying to achieve that goal. And I personally think that it's hard to just say that, oh, I want to retire. How much? I don't know. And when probed further why, then you tell me just because. Then I think the motivation would be chipped away slowly but surely. So we must also understand that different people have very different genetic makeups. And self-awareness is the first step to any decision-making process. So don't fall into the trap of buying into someone else's scoreboard or definition. So if you really love that Hermes bag, please go for it. If you love staying in a luxury condo, I think nobody's stopping you from buying it. But like I alluded previously, you must really be sure of what are the trade-offs that you're getting yourself into. Unless, of course, if you're an entrepreneur or if your father is Peter Lim, which is a billionaire in Singapore, then you can probably do whatever you want, but it's all about managing your own personal expectations. And last but not least, for those of you who actually sat through the entire video, I think comparison will never end. There will always come a point where you will have to be saying, F this, I don't care anymore. And some people tend to jump out of it earlier than others. So the sooner you get over this, I think the faster you'll feel liberated. And comparison is important for a basis of benchmark, but you must recognize that there is only a small sliver of scenarios that it makes sense. Thereafter, I think as time passes, priorities change, and not many people actually give emphasis on the element of luck. And when you take that into account, then I think comparing no longer hold any purpose. And for myself, when you actually attain that end goal of being able to think and speak independently, I think you get the level of clarity that you've never seen before, and you're no longer dependent on something or someone. And that's exactly the point of why you need financial security. And with that in mind, I hope you enjoyed this discussion, and I'll see you in the next video. But more importantly, and hopefully, I'll see you guys on the moon. Goodbye.